Welcome, everyone, to the Zion's Wealth Economic and Financial Market Outlook webinar series. I'm Anthony Valeri, Director of Investment Management. Today, I'll spend about 20 minutes covering our thoughts on the economy and financial markets. We will then move to question and answer. So let's go ahead and get started. We'll start with the focal point that has been the focal point for markets and driven all investor interest, and that is oil prices. And the reason this ends up being a major focus, of course, is that oil can be a drag on consumer spending and therefore the economy and in turn, corporate profits. So as you see here, oil prices have been very volatile as of late, almost hard to see on the right-hand side of the chart. A historic spike occurred in early March when oil prices, as measured by West Texas Intermediate, rose above $100 a barrel before dropping to a level close in the low 80s. And as of this morning, in the mid 90s range, that is still a significant increase over the $60 to $70 price of oil per barrel that existed prior to the conflict. So while oil remains very volatile and may continue to impact markets, we don't think by itself it is enough to derail the economy and financial markets. And just looking at this chart, you'll see that there are several periods over the last 15 to 20 years where oil's been in this range. And while it has during 2008, a driver of the recession, we think it's manageable and more of a slow growth potential outcome. But again, with the ceasefire, oil prices have come down. We don't think we're out of the woods as that ceasefire ends, fragile ceasefire ends Wednesday, barring a new agreement. So it's still a driver of financial markets, but the progress on negotiations giving optimism to investors. That ceasefire has led to a very sharp rebound in equity markets. You'll see that in the upper chart here, the S&P 500. And you'll see that it eclipsed two key technical indicators, the 250-day moving average. And when it moved above those metrics, it gave validity to the bounce back. So one of the strongest bottoms or rebound from a bottom to a new market high on record. In fact, this was the 11-day rally to a new record high was the strongest ever of 8% or more over such a short period of time since 1950. And the upper, again, reflected here in the upper chart. In the lower chart, we show the RSI, or Relative Strength Index, which measures how far and how fast stock prices move, and it can measure both to the upside and the downside. And when it reaches the upper end of that band, the green line, that means the market is overbought. That doesn't necessarily signal the end of a rally. However, it does suggest some consolidation may be likely to occur after such a strong gain. So markets have responded in kind to the better outlook, more potential for a ceasefire and the end of a conflict. The historical pattern on oil prices is still valid. Again, we're not out of the woods in terms of market volatility, but just to frame this and put it in perspective, in early March, we had one of the strongest 5-day spike in oil prices, or one of the strongest on record. And we list the 10 strongest here in this chart with the 5-day rally in early March at the bottom. And then we show subsequent S&P 500 performance. And you'll see that this current environment suffered an 8.2% decline. But if you look at the averages on the bottom, you'll see that market returns are generally muted out to 6 months following an oil price shock. So this has been we've had a strong rebound in stocks, but the total return since the conflict began is roughly in line with where we have seen stocks in the 3 to 6 month range. It suggests that there's a little more churn in the market potentially ahead. But if you look further out to 9 months and 1 year, the stock market generally has surpassed this turmoil and has led to above average returns over a 9-month and 1 year period. So history suggests that disruptions to the stock market from oil prices tend to be short-lived, and we stick by that in our investment approach. And the geopolitically driven market is another reminder to stay invested and not move to cash. History shows that it pays to stay invested. And in this chart, we show the 1 year performance of a typical 60% stock, 40% bond portfolio relative to cash as measured by the 3-month Treasury bill. And what you'll see is over a 1 year time frame, cash outperformed the 60/40 portfolio only 3 times, but over a 3-year horizon, lagged every time. And on the far right, we show the average performance differential. So over the trailing 1 year, the diversified portfolio has, on average, beaten cash by 9 percentage points, and on a 3-year by a cumulative 24% margin. So again, latest reminder not to let geopolitics influence your investing view. All right, all of the turmoil led to a muted first quarter in terms of performance. Here we look at asset class performance. In REITs, equity REITs benefited. Equity REITs did benefit from the focus on commodities and real assets as oil prices increased, but there were segments of the market that did manage some gains, mid caps and small caps. And on the far right, you'll see that U.S. large caps were down just over 4%. So a mixed quarter for investors, a challenging one at that, and the S&P 500 lagged. But as investors know, it's been a good year for investing, and we've looked at trailing 1-year performance as of the end of March. Emerging market stocks, small caps, and international stocks have led the way. So a good year for investors. Again, positive returns here across the board. And of course, with the rebound so far in April, those have improved still further. One of the notable themes in the first quarter was the better breadth in the S&P 500. The past 3 years have seen a very concentrated market with very few stocks outperforming the S&P 500 as the big mega cap tech stocks have outperformed. The Mag 7 have dominated. In the first quarter, 56% of S&P 500 constituents outperformed the index. So diversification did pay off. We think it is the right approach for a longer term investor. So good to see that diversification paying off. And again, when you see that diversification, it generally reflects a healthy market as the rally broadens out. Now, in the beginning of April, investors have taken advantage of beaten down tech stock valuations to see some of that concentration return. And here's another way to look at it. Diversification certainly helped to start the year, and this chart reflects the character of the market. Up until the airstrikes began, international led the way, and then once that began, the U.S. benefited from safe haven flows, and those performance gaps narrowed. On a year-to-date basis, the S&P 500 is lagging, but closing the gap as, again, investors focus on those beaten down tech valuations. Should oil prices spike again, we think that value sectors of the market may come into focus again. They have a little bit more of a commodity sensitivity there. One area that continues to lead is small caps, which are more domestically focused and therefore insulated a bit more to global events. Small caps outperformed domestically early this year and have continued to maintain their strength even here in April. So we maintain a small overweight to small caps. We're within our equity allocation. Now we move to a little more into equity detail, and one of the key drivers that we focus on is earnings, and earnings ultimately drive the stock market. Interesting phenomenon where earnings estimates actually increased even after the start of the conflict. And that is a testament to the strength of corporate America. Earnings growth, higher earnings expectations provide a strong fundamental backdrop to investing in stocks. The first quarter earnings season has just begun, and so far the results have been good. So the underlying fundamental case for U.S. equities still very much strong. And here's a little more detail at broader earnings, which are expected to be strong. And keep in mind, we're coming off 5 consecutive quarters of double-digit earnings growth in the S&P 500. The first quarter is actually tracking to just above 14% right now, again, early. And the expectation is for double-digit earnings growth for the remaining quarters of 2026. Even if we think those estimates might be a little high, but even if they come down, there's a buffer to absorb slightly slower profit growth, again, far away from levels that would create more problems for equity investing or a broader sell-off. So the fundamental backdrop, very strong, and these growth rates well above the 7% historical average. And when you look at earnings globally, they are strong as well. Here we look at not just U.S. earnings growth, even with mid caps and small caps, but also at developed international and emerging market equity. You'll note that the outlook for developed international is a little weaker. Europe makes up about 50% of developed international markets, and Europe is most likely to be impacted by stubbornly high oil prices. So we look at that segment of the market with a little more skepticism. What we do find attractive is the strong growth rates reflected in emerging market equity. And while there are countries that are impacted by oil prices, there are energy exporters that may stand to benefit. So we find emerging markets certainly among the more attractive equity segments here in the markets, and have a slight overweight relative in our investment strategies. Let's take a look at the economy. And in the year started out on a strong note for the economy. Here's the ISM survey data, two top-tier economic reports that we focus on, covering both manufacturing and services. And the economy has moderated during the Iran conflict, but important to note the underlying momentum was very positive heading into the conflict. The ISM improved to start 2026 with the manufacturing index above the 50 expansion contraction line for the first time since 2022. Both data points reflect improvement in underlying conditions ahead of the Iran conflict, and also suggest the economy has capacity to absorb some headwinds from higher oil prices. Consumer spending holding in steady even with higher oil prices. Here we show a high frequency indicator. This is Bloomberg's second measure spend to capture the latest spending by consumers on overall goods, and then just pulling out gas stations. And you can see that spending actually increased in March. Most of that, however, due to gasoline expenditures, unfortunately. But you'll see even broader expenditures held steady. So that speaks well to consumer spending that has been very resilient. And this morning, the retail sales data for March was stronger than expected, although driven by higher energy spend. The underlying metrics to other areas was also stronger than expected, and that'll feed through to GDP. So some good numbers from the consumer, which remains steadfast, even though they say they don't feel too good. Consumer sentiment has been depressed and is in real stark contrast to the actual data of what they do. A reminder that consumer sentiment can be a contrarian indicator. So although it's very depressed, if you look at forward one-year performance of the S&P 500 at these bottoms, it tends to be very, very strong. So keep in mind that this can be a contrarian indicator. And again, historical performance, very strong. So how has the consumer managed to stay resilient? Well, fiscal stimulus is here. Here we show year-to-date income tax refunds compared to 2025. This through April 10th, or it was a 46 billion difference. So that is a significant boost to consumers. That number has increased closer to 60 billion here in mid-April. So a significant boost from stimulus that is helping to offset the higher gas prices. However, that is a drag, and the refunds obviously are going to stop here soon. So whether gas prices remain elevated could still pose a risk in terms of reduced consumer spending. According to data from the Energy Information Administration, consumers have spent an additional 10 billion more on gas due to higher oil prices. Other estimates are slightly higher on that number, but not enough to offset the favorable impact from stimulus. Again, a lot of that will determine on how long oil prices remain elevated. The one soft spot in the economy is the labor market. Monthly job growth has been very minimal, not just this year, but even over the last 12 months. We haven't seen much growth in the labor force. On the other hand, we haven't seen much in the way of firing. It's a low hire, low fire labor market environment, as you can see here from jobless claims. This is one of our favorite leading indicators. Weekly jobless claims remain near a historical low. If there's going to be trouble in the labor market, you'll see it here first. Again, not seeing any concerns here. So it's more of a low hire, low fire environment. On to inflation. and inflation was contracting marginally ahead of the Iran conflict. And you can see when we look at the latest CPI report, the increase is all due to energy prices. You can see that component boosting overall CPI on a 3.3% year over year basis. Again, overall, we're not worried about inflation generally outside of the energy impact. There are lots of factors pushing inflation modestly lower. The one risk is if the oil does stay elevated, you may see some path through to food prices, which may continue to increase. And the longer they increase, the greater the potential drag to spending and therefore the economy. So a potential risk there from some knock-on effects from higher energy prices. On a positive note, energy is a much smaller share of consumers' wallets. You can see the declining share of oil it's relative to expenditures over time. Certainly it peaked in the late 70s and has been coming steadily down. So by itself, again, as I've mentioned earlier in this webinar, don't see oil prices as by itself bringing down the economy or being that big a negative for corporate profits. But if anything, more of a slowdown than any kind of recession along those lines. Let's turn to fixed income, and the market has been moved around a lot from expectations of rate cuts from late last year through to early this year, then all the way back to reversing those rate cut expectations to even pricing in a small probability of a rate hike as oil prices surged and investors feared inflation and that the Fed would have to hike rates to counter those inflation concerns. With the ceasefire news, futures have moved in the other direction with a roughly 50% probability of one rate cut later this year. We think these expectations are roughly fair. It is another reason why we expect bond yields to remain relatively range bound. Yes, bond yields increased to start the year following that inflation scare, but we still see the 10-year between 4 and 4.5. Given these, what we think are fair expectations for potentially one rate cut. We do think the Fed follows through late this year with a rate cut. To see yields spike substantially higher, we need to see much higher inflation and a sustained run in inflation. Conversely, to see yields much below that 4% band, we need to see signs of a recession. So we'll keep an eye on that. But in the meantime, we think those expectations are fair. And the market did panic about higher energy prices and what that might mean to bond yields. The knee-jerk reaction from the bond market was a spike higher in yield. But if you look back over the past 20 years, any surge in oil prices, and we show prior shocks here of 25% or more, have actually been a positive for bonds in the sense that that increase in energy prices ends up being a tax on consumers. It slows the economy, and bonds typically react with lower yields. For the Bloomberg Aggregate Bond Index, it has led to good returns over the following 6 months and 1 year. You see average returns there at the bottom, up 2.8 and 6.2% respectively. And then on the 10-year Treasury yield, we show the changes. And while it certainly hasn't been in one direction all the time, and the average change on the 10-year has been down 30 basis points or 0.3% over 6 months, and down 0.4 over 1 year. So all else equal, bond yields ultimately come down as that increase in energy prices retards economic growth. So we think the surge in yields that we saw in March a little overdone as in the bond market. And again, see bonds as roughly fairly valued and maintain a focus on intermediate bonds. We also maintain a focus on high quality bonds. The risk-off environment of March led to a modest increase in yield spreads. That's the added yield advantage of investing in lower rated bonds. But you can see here that compensation remains very low relative to history. So you're not really being properly compensated for lower rated bonds in our view. We maintain a high quality focus, finding high quality bonds fairly valued. Where we find more standout value within the bond market is in municipal bonds. So certainly for higher tax bracket investors, the taxable equivalent yields are very compelling. We show that here when we look at the yield curves for U.S. Treasuries, investment grade corporates, and average AAA muni yields. That gap or that additional yield becomes more pronounced in the 10 and 20-year part of the muni market. And you'll note that, or should note that municipal bonds beyond 10 years have a call feature, so they don't always go to those final maturity dates. But some very compelling after-tax yields still exist in the muni market. They were even more attractive last year, but that gap has closed, but still find munis attractive for higher tax bracket investors. So those are my comments on the economy and financial markets. I'm going to bring on my colleague, Chris Constantine, Director of Wealth Management, to join.
Thank you, Anthony. Great job, as always. I think you do a fantastic job of providing clarity when it can be difficult to find with given all of the various data points that you have. And I especially appreciate the fact that you incorporate so much historical data in there, which I think can be really informative for a lot of our investors so that they really start to take that longer term view. So thank you for that, Anthony. We do have some questions from the audience and want to get your thoughts on these various items as well. So the first question was, do you think this year needs to be a preservation kind of year, perhaps a defensive year with less growth? What are your thoughts there?
Yeah, I don't necessarily think that the case. That ends up being a case of trying to time the market, in my view. If you have an investment plan, if you've planned out what you need the goal of your investments, then I wouldn't change strategy. We've got several cases, and I showed that slide on investing through those various geopolitical events. You don't want to try to time the market. So while it could be a challenging year, and historically midterm election years have seen very muted returns until after the election's done, I wouldn't change a strategy based on that. So my message, Chris, would be stay the course. Don't try to time this market or adjust what could be a short-term phenomenon.
That's great advice. So you talked a little bit about international markets. Obviously, we've got this Iran conflict that's taking place. I'm curious, the question was, in terms of expected performance for the international markets, and also for emerging markets. What are your thoughts for those two?
Yeah, we like emerging markets. The earnings outlook is very strong. It continues to be strong. There could, as I mentioned on the webinar, there's a few countries that could be adversely impacted, but there are energy exporters, and the earnings story to us is the fundamental driver. So we like that. We find that a more attractive part of international. There is reason to be a little more cautious on developed international, where Europe makes half of that index and more likely to be impacted by higher Brent oil prices, which could be a drag. And coming into the conflict, those earnings expectations were lower to begin with, which is ultimately a driver in our view. So we took a cautious look in our as we looked at investing even before the conflict. So have them in the portfolio, remain diversified, but they should not be an overweight allocation on developed international.
So talk to us about treasury bonds right now. What is your feeling about that?
There might have been an opportunity when yield spiked in March, but we're neutral to high quality bonds overall. And I wouldn't recommend investors just go into treasuries by themselves. We think you should have a diversified approach, include mortgage-backed securities, include corporate bonds, investment grade corporate bonds. You're getting a lower yield with treasuries because of the safety. But we think high quality bonds overall, a diversified approach to high quality bonds, still the right way to go, with an emphasis on intermediate maturities.
Great. And you showed on that one particular chart the advantage of perhaps munis at this point in time as well.
Yeah, no, that's our favorite area. For those that can benefit from the tax savings, it's the most compelling within the high quality bond market.
Great. Good. All right, another question. So I know this morning the new Fed chairman is in front of Capitol Hill. Mm-hmm. So the question really is, when we do have a new Fed chairman, what do you anticipate from him in terms of rate cuts? Any early signals?
Yeah, there's always that concern the Fed's going to lose their independence. The one thing I reiterate to all investors: look, the Fed there's 12 votes on the Federal Reserve board. So one person can't influence it. You've seen already there's been dissents going back to last year. Stephen Moran, who's a Trump appointee, has been arguing for rate cuts, but he's been outvoted, and the Fed has held firm here in recent months. So or it's certainly not cut as much as he would have expected late last year. So again, it's 12 votes. One person can't really sway the Fed. What Kevin Warsh brings that I think could be favorable is looking at bond purchases differently, and that quantitative easing has had some unintended consequences in raising asset prices and not being a true benefit to the U.S. economy. So I think that scrutiny on quantitative ease and buying bonds is probably warranted. But in terms of cutting rates, I don't think he's going to do anything materially different than what the broad Fed has set out to do. Again, just one vote of 12.
Gotcha. And just as a follow-up on that, when do you think we might see another rate cut?
In terms of a next rate cut, I think late this year, inflation has been a little stubborn. I still think there's enough factors pushing down on inflation outside of energy that once this oil price, I think the Fed will look through the spike in oil prices and opened up the door to another rate cut later this year. So one 25 basis point rate cut later in the year, largely expected. So, but that's our expectation going forward.
Gotcha. Great. What do you think is going to happen with housing this year?
I always get a lot of questions on housing. I think we're in the middle of a long-term trend where we see very little price appreciation. There might be segments there that are more attractive relative to others. But when you look at real estate broadly, unless it's a niche approach, it's residential housing, for example, benefiting from tight supply that's holding in prices. But at the same time, we have a big affordability problem. So from an asset class perspective, we don't necessarily find real estate attractive and don't use them currently in our strategies. And I think it's more of a very low appreciation environment for the next several years.
Interesting. Great. Last question. So how do you see the US dollar in strength or weakness for the remainder of 2026?
Yeah, that dollar gets a lot of questions as well, kind of like the Fed question. Is dollar dominance over? And the answer is no. It's just there's no currency that's as deep or as liquid, so that this concern that investors are going to move away from the dollar, I think, is misguided. In fact, investors continued to invest in the U.S. In recent months. There hasn't been a change there. This America buyer strike has proven to be a myth that's been debunked. So investors are still coming here. What I think investors may forget is that the U.S. dollar, even after declining last year and this year, is down slightly after actually starting the year a little stronger. It's still the valuation of the U.S. dollar is still high on a historical basis. So it would be normal to see some modest dollar depreciation going forward. That would not be alarming. It's more a reflection of the dollar falling back into a more reasonable valuation relative to other currencies. But I don't see the dollar losing its safe haven status or its reserve currency status on a global basis. Tariffs, I think, have worked against the U.S. dollar last year. This year, the safe haven flows have benefited. Until recently, the dollar weakened again. But again, wouldn't be surprised to see some additional modest weakness over the remainder of the year.
Great, Anthony. So the demise of the dollar is not quite upon us yet.
Not quite yet.
That's great. Well, those are all of the questions that we had, Anthony. Thank you so much again for doing this on a quarterly basis. You bring so much information and historical background to this, and we really appreciate your insight on all of this. And we thank everyone who joined today. Please continue to reach out to your relationship managers with additional questions. We'll make sure to try and get those on our next quarterly review with Anthony Valeri. Thanks so much.
Thanks, everyone.